Okay, let's kick things off. We're looking at this really interesting piece you sent over from Motley Fool. It does a deep dive comparing two companies that feel kind of opposite at first glance, Uber and Carvana.
Right. Uber, the ride-hailing delivery giant,
Yeah.
sort of representing a move away from owning cars.
Exactly. And then there's Carvana, the online used car dealer, trying to make owning a car, easier.
But the article notes, hey, both seem to be doing pretty well lately.
Yeah, which leads to the big question, the peace tackles for investors. Which one is the clearly better bet right now?
And that's our mission for this deep dive. We're going to unpack the analysis in the article, look at the arguments for each company.
And really understand why the author lands so firmly on one side over the other.
It's about going beyond just the recent performance headlines and looking at the bigger picture forces.
Absolutely. So let's lay out what the article tells us about each one's business and their recent performance based on its reporting. Uber first.
Sounds good. So the article reminds us it's not just ride-hailing. I mean, they basically created that whole industry here in the U.S.
Right, and their market share is huge. The source mentions, 3/4 of the U.S. market, citing Bloomberg data?
Yeah, dominant. And the financials for 2024 that the article pulls out are pretty massive. Over 11 billion rides facilitated.
11 billion. Wow.
Yeah, and that was up 18% from the year before.
Okay, and revenue.
Nearly $44 billion in revenue. And they actually posted almost $3 billion in operating net income.
That's significant. And the article makes this interesting point. Almost half of that revenue wasn't even from passenger trips.
Right, exactly. It came from deliveries and their freight services. They're definitely diversifying.
So not just a one-trick pony anymore. And the outlook, according to the source, is still pretty strong. Another 18% revenue growth expected this year.
Yeah, the article does note that, mathematically, the rate of growth might slow down as the numbers get bigger.
Sure, law of large numbers.
Right. But the actual dollar amount of growth they're adding each year is still huge and expected to keep going.
Okay, solid picture for Uber from the source. Let's switch gears to Carvana. The article positions them as the online used car dealer making ownership easy and affordable.
And their numbers recently have also been, quite eye-catching.
Yeah. What did the source say for 2024?
$13.7 billion in revenue. That's a big jump, 27% year over year.
27%, okay.
And get this, a record-breaking $404 million in net income.
Wow. Okay. And where's that profit coming from, mainly?
Well, according to the article, most of it was from the retail side, selling used cars directly to people, even though their wholesale business actually moved more units, more cars.
So the margins are much better on the retail sales. That's key.
Definitely. And the article suggests this recent surge for Carvana is down to a few things, like a rebound in demand after inflation kind of squeezed everyone post-COVID.
Right. People putting off purchases, maybe?
Exactly. Plus, clever marketing and using tech to scale up their operations.
Okay. So based purely on those 2024 growth numbers, both look pretty healthy.
They do. But this is where the article highlights this really stark contrast in their stock performance.
It's pretty wild, isn't it? Carvana shares, the article says, are up over 200% in the past year, testing those old 2021 highs again.
Just incredible performance.
Heavier?
Meanwhile, Uber, despite those strong operating results we just talked about,
their stock's basically gone nowhere since March of last year, right? The article mentions some earnings reports maybe not quite meeting what the market expected.
Yeah, some setbacks there. And this difference, this divergence, leads the article to ask, maybe the market's kind of lost the bigger picture perspective here.
Like, why reward Carvana so dramatically more than Uber right now if both are showing decent growth?
Exactly, which sets up the deeper analysis in the article, the microscope and macroscope view, as it calls it.
Okay, let's get into that. Starting with Uber and what the article calls its connection to secular trends. What exactly does the saga mean by a secular trend here?
It defines it as, like, a really long-term shift.
Yeah.
Something fundamental changing in society or an industry that isn't just a temporary blip, it's unwavering.
Got it. Like a tide, not just a wave.
Precisely. And the big secular trend the article says Uber is tapping into is this growing group of people, especially younger folks, who just aren't that interested in owning a car anymore.
That feels true. You hear that a lot. Does the article have data on that?
It does. It cites a Deloitte survey that found this really stark difference. In the U.S., only about 11% of people over 55 would think about giving up their car.
Okay, not many.
But for those under 35, it's 44%.
44. Wow, that's a massive difference.
Huge generational gap. And there's more. The source also points out how the percentage of teenagers getting their driver's license has plummeted. Like, 30 years ago it was about 2/3.
Yeah?
Now it's closer to 1/3.
1/3. That really tells a story, doesn't it?
It's a fundamental change in behavior.
Yeah.
And the article argues Uber isn't just benefiting from this, it's actually helping it happen. It provides that convenient alternative.
Making it easier not to own a car.
Exactly. So the argument is this paradigm shift is real and likely to keep going for years, especially as those younger generations get older.
And the market projections the article mentions seem to back that up.
Yeah, it cites forecasts like the global ride-hailing market growing over 11% a year through 2033.
Okay.
And food delivery, Uber's other big area, growing even faster, like 17% annually. So the point is Uber's positioned right in the middle of these really long-term, enduring trends.
Okay, that makes the case for Uber's long-term position pretty clear.
Yeah.
What about Carvana then? The article does acknowledge a big plus for them. New cars are just so expensive now.
Undeniably. And the article puts numbers on it using Kelley Blue Book data. Average new car price in April, around $48,700.
Ouch. That's a hefty monthly payment. Over $700, the article says.
Yeah. Compare that to the average used car price, cited about $25,500. So, roughly half the monthly payment. That's a powerful draw.
Absolutely. Big savings. But the article adds this important footnote, right, about the car business being incredibly cyclical.
And that's the key difference from a secular trend. Cyclical means ups and downs, tied to the economy or specific industry stuff that might not last.
Okay, so what are the cyclical factors or challenges for Carvana right now, according to the source?
A big one is inventory. The article cites Edmunds data showing a decade low in the supply of 3-year-old used cars.
Why 3-year-old cars specifically?
That's apparently Carvana's sweet spot.
Yeah.
Young enough to be reliable, but old enough to be much cheaper than new.
Ah, okay. And why the shortage?
It's a direct result of fewer new cars being made and sold back in 2020 to 2022 during the pandemic disruptions.
Right. The supply chain issues then ripple through to the used market now. That makes perfect sense.
Yeah. And the article mentions another factor boosting used car demand lately, just how old the average car on the road is. S&P Global Mobility data puts it at 12.6 years.
12.6 years. Wow. So people basically have to replace them eventually.
Exactly. More replacing, less repairing at that age. Now, the article does concede that the underlying need for cars isn't going away.
People will always need cars, sure.
Right. But it frames this current surge in demand, driven by the old fleet, and the specific inventory shortage as maybe more temporary, more cyclical.
Compared to the fundamental shift away from ownership that helps Uber.
That's the argument. The article also notes Carvana's market share is still tiny, like 1%, so there's room to grow by taking share.
Consolidation potential.
Right. But it weighs that against the idea that the current tailwinds might not last forever at this intensity.
Okay, I think I'm getting the core argument now. The article isn't just saying who grew faster last year. It's asking why they grew.
Exactly. Is the growth engine built on these huge, long-term, maybe unstoppable shifts, like for Uber?
Like people ditching car ownership, growth in cities, on-demand everything.
Right. Or is the growth, like Carvana's impressive recent run, more tied to maybe temporary factors within the car market cycle? Inventory hiccups, the current age of cars on the road, things that might normalize.
So the conclusion leans towards Uber's growth being driven by something more fundamental, more built to last, as the article puts it.
That's the takeaway. It suggests Carvana's surge, while real, might not represent a new long-lived norm in the same way Uber's path seems tied to these bigger societal changes.
And the valuation piece fits into this narrative too, right? How the stocks are priced relative to expectations.
Yeah, the article uses that as supporting evidence. It points out Carvana's trading, 14% above the average analyst price target?
So maybe expectations are already really high or even overheated.
That's the implication. Whereas Uber is trading about 16% below its average analyst target, which the article pegs at $97.39.
And most analysts rate Uber a strong buy, according to the source.
Correct. So the valuation picture seems to suggest the market is pricing in more sustained long-term growth for Carvana right now, while maybe underappreciating Uber's potential despite those secular trends.
Interesting. So weighing the underlying trends, secular for Uber, more cyclical for Carvana, and looking at those valuations.
The article lands pretty decisively.
Uber is the clearly better stock to buy right now. That was the conclusion.
Yeah, it really boils down to that distinction. Is this success fueled by lasting forces or temporary conditions? The article makes a strong case that Uber's got the more durable engine.
Which, brings it back to you, the listener. thinking about this difference, these deep secular trends versus maybe shorter term cyclical bounces, how does that help you evaluate opportunities?
It's a really useful lens, isn't it? Not just for stocks, but for understanding industries in general.
Totally. It's not just about who won the last lap, but who set up best for the whole race, considering the track conditions ahead.
Well put.
And here's a final thought to chew on, building on that secular trend idea for Uber. If this move away from owning cars really does pick up speed, like that Deloitte survey suggests it might,
Yeah.
what else changes? Think about the ripple effects, other industries, how cities are designed, parking, insurance. It could reshape a lot. How might that influence decisions you make, investing or otherwise? It's fascinating to think about how these big shifts can ripple outwards.